All right, future Florida real estate superstars, welcome. If you're gearing up for that big state exam, then you are absolutely in the right place. Today, we're going to crack the code on one of the most important and, let's be honest, sometimes confusing topics, settlements and closings. So, let's just dive right in.
Okay, so here's our game plan. We're going to kick things off with a real-world challenge, something you'll actually see. Then, we'll get into the nitty-gritty, breaking down the numbers you absolutely have to know. After that, it's a quick run through the terminology vault. We'll expose those common exam traps, and then we'll finish strong with a final 60-second cram session. Sound good? Let's do it.
First up, let's talk about the closing day challenge. Look, every single math and settlement question on that exam, it's not just random numbers. It comes from a real-life situation. And here's the secret. If you can just get the why behind it all, trust me, the how, the actual math, becomes a million times easier. So picture this. You've got your first buyer, they're sitting across from you, and they look at the paperwork and say, wait a minute, why am I being charged for the seller's property taxes? This doesn't feel right. See, this question right here is the heart of it all. It's all about something called proration, just a fancy word for splitting the bills fairly. And being able to explain this, that's what makes you look like a pro. Plus, it's going to score you some serious points on that exam.
Okay, so let's see how this all translates into actual dollars and cents. It's time for Section 2, breaking down the numbers. Now, don't let the word math scare you off, okay? Seriously, this is where you can pick up a ton of easy points if you just master a couple of key formulas.
And boom, here it is, our first exam alert. Listen up, because I can pretty much guarantee you're going to see questions on the exam about state transfer taxes. So, if you're taking notes, this is the time to circle, star, highlight, whatever you got to do. This is absolute must-know stuff.
Okay, there are really only three big ones you need to burn into your brain. First up, you've got the dock stamp tax on the deed. Just think, 70 cents for every $100 of the sales price. 70 cents for the sale. Got it? Then there's the dock stamp tax on the note. This one's easy. It's just half of the first one. So 35 cents for every $100 of debt. And finally, you have the intangible tax on new mortgages. This one's a little different. It's 0.002 times the loan amount. Or an easier way to think of it is just $2 for every $1,000 of the new loan. So let's run that back. 70, 35, and 2. That's it.
Let's put this into practice. Make it real. Say you have a $300,000 home. First step, how many $100 units are in that price? Super simple. Just take the price and chop off the last two zeros. So 300,000 becomes 3,000, right? Then you just multiply that 3,000 by our 70-cent tax rate for the deed. Pop that in the calculator, and you get $2,100. That's the tax. See? It really is that straightforward.
Okay, so that naturally leads to the next big question, right? The one your clients are definitely going to ask, and you know the state exam will too. With all these different costs, who actually pays for what at closing?
Think of this as your go-to cheat sheet. Generally speaking, the seller is on the hook for the deed doc stamps, the thing we just calculated, and of course the real estate commission. Now, the buyer, they typically handle the taxes on their new loan, like the note and mortgage taxes, and they also pay the fees to get everything recorded. You absolutely want to remember this division of costs. It's a classic setup for exam questions.
So where does all this stuff get tracked? Well, all these numbers, all these different costs, they all come together on one super important document, the closing disclosure. The easiest way to think about it, it's the final scoreboard for the entire deal. And everything, I mean everything, gets sorted into two really simple columns: debits and credits.
And here's the logic behind that scoreboard. It's so simple. A debit is a charge. It's money you have to pay out. So for the buyer, the biggest debit is obviously the purchase price itself. A credit, on the other hand, is money that's in your favor. Think of it like a gift card or a discount. So for that same buyer, the earnest money they already put down, that's a credit. The big loan they're getting from the bank, that's a credit too. It reduces how much cash they need at the end. I'm telling you, if you can just get this simple debit-credit logic down, you've basically mastered the entire closing disclosure. But to really truly master it, you've got to speak the language. So, it's time to open up the terminology vault and make sure you sound like you know exactly what you're talking about. Okay, first word up, proration. Sounds complicated, but it's not. It's just a fancy term for splitting expenses fairly. I mean, think about it. If you moved into an apartment with a roommate halfway through the month, you wouldn't pay for the whole month's rent, would you? Of course not. You'd only pay for the days you were actually living there. That's exactly what proration is for things like property taxes at closing.
Next up is the word arrears. This just means you're paying for something after you've already used it. And listen, here comes another massive exam alert.
In Florida, property taxes are paid in arrears. What does that mean? It means the tax bill you get in, say, November of this year is to pay for this entire year. You pay at the end for the service you've been getting all along. This little detail is absolutely critical for getting those proration questions right.
Okay, let's really nail this down so there's zero confusion. A debit is a charge, period. It's a bill. It's money going out of your pocket at the closing table. Simple as that.
And a credit? It's the exact opposite. It's money coming to you, or it's an amount that reduces what you have to pay. So credits are your friend. Debits are charges, credits are favors. That is the entire foundation.
All right, time to shift gears. I'm putting my coaching hat on for this next section. Common exam traps. You have to know that the people who write this exam, they love to set up these little traps. Questions that look super easy on the surface, but have a hidden twist designed to catch you. So let's expose their tricks so you don't fall for them.
Okay, here's a perfect example, a classic exam-style question. A property closes on June 10th. The seller has already collected the full month's rent, which is $1,200. The question says to use the 30-day month method. So what's the proration? How do you show that on the closing disclosure? Take a second, pause if you need to, and think about how you'd solve that.
Did you fall for the trap? The common mistake here is to start calculating how much rent the seller earned for their 10 days. Don't do that. Why? Because the seller already has all $1,200 in their bank account. The real question is, how much does the seller owe the buyer? The buyer will own the property for the rest of the month. That's 20 days, right? So you have to calculate the rent for those 20 days, and that's the amount the seller has to give back. It's a debit to the seller and a credit to the buyer.
And that brings us to our final and maybe most important exam alert for today. The question will always tell you which calculation method to use. It'll either be the 365-day year, the real calendar, or the banker's method, which is a 360-day year where every month has 30 days. Just reading the question carefully is literally half the battle. Please do not give away easy points by missing this detail.
Okay, team, we have covered a ton of ground. It's time to bring it all home with our final 60-second cram. If you forget everything else we talked about today, just lock these next 3 points into your brain for exam day. You ready? Let's hit it.
Number 1, taxes are everything. You have to know those 3 state transfer taxes, remember the numbers, 70 cents for the sale, 35 cents for the debt, and that $2 per thousand intangible tax. Know the formulas, know who pays. This is guaranteed point territory on the exam.
Number 2, debits versus credits. It sounds basic, but it is the absolute bedrock of the entire closing disclosure. A debit is a charge, money out. A credit is a favor, money in your column. Do not overthink this one. It's that simple. And finally, number 3, proration logic. The golden rule is simple. You only pay for the days you actually own the property. That's it. Stick to that rule and always, and I mean always, double-check if the question wants the 360 or the 365-day method. You've totally got this. Now get out there and go crush that exam.